They say crypto is the future, but the numbers hide a brutal truth. What if I told you the average Bitcoin crash wipes out more wealth than the 2008 financial crisis combined? You've probably heard the hype: digital gold, decentralized freedom, the next big thing. Those buzzwords sound exciting, but they also mask a cold statistical reality. In the next few minutes, we'll peel back the hype and look at the raw numbers. We'll compare crypto's wild swings to the steadier rhythms of stocks, bonds, and even real estate. By the end, you'll see why the volatility story matters far beyond a headline grab. You'll also discover a hidden pattern that most traders overlook, and it could change how you think about risk altogether. First, let's define what we mean by volatility. In finance, volatility is simply the degree of price fluctuation over a set period. It's measured by standard deviation, which tells us how far prices stray from the average. A high standard deviation means wild swings. A low one means a smooth ride. Most people equate volatility with danger, but it also signals opportunity. The key is not whether an asset moves, but how often and how deep those moves go. That's where crypto begins to diverge sharply from traditional markets. Now imagine you're watching a roller coaster from the control room. A traditional stock index, like the S&P 500, is a gentle hill. It climbs, dips a little, and keeps moving forward. Bitcoin, on the other hand, is a loop-the-loop that launches you upward, then drops you into a dark tunnel, only to catapult you back up again. The difference isn't just excitement, it's measurable risk. According to a study by the Federal Reserve, the S&P 500's annualized volatility over the past 30 years hovers around 15%. Bitcoin's 30-day rolling volatility, by contrast, has averaged closer to 80%, spiking above 150% during extreme events. That's a five-fold difference. Here's a retention bump. Bitcoin has lost more than 80% of its value 3 times in the past decade. Each crash happened within a 12-month window, and each time the market recovered, but only after a painful, drawn-out slog. Ask yourself, could you stomach a loss that deep twice in a single lifetime? Let's dig into the numbers. Between 2013 and 2023, the median drawdown for major equities, think Apple, Microsoft, Johnson & Johnson, was roughly 30% during the worst market correction. Even the infamous 2008 crash, which saw the S&P 500 tumble 57% from peak to trough, remains an outlier for equities. Crypto, however, paints a different picture. In the same 10-year span, Bitcoin experienced median drawdowns of 60% to 70%. Ethereum, the second largest cryptocurrency, posted median drawdowns exceeding 80% during its most volatile periods. Those aren't just numbers, they're real dollars disappearing from portfolios overnight. Why do these drawdowns matter? Because they dictate the capital you need to survive. Imagine you start with $10,000. A 30% equity dip leaves you with $7,000, still enough to stay in the game, maybe even buy a few more shares at a discount. A 70% crypto plunge is that same $10,000 to $3,000. Your buying power evaporates, and the psychological impact can be crushing. That's why many seasoned investors talk about drawdown tolerance as a core component of any strategy. If you're unwilling or unable to endure a 70% loss, crypto's volatility may be fundamentally mismatched to your risk profile. Next, let's compare the recovery speed. Traditional assets have a historical tendency to rebound, often within a few years. After the 2008 crisis, the S&P 500 took roughly 4 years to recover its lost ground, and it has since reached new highs. Bitcoin's recovery timeline is far less predictable. The 2018 crash, which erased about 84% of Bitcoin's market cap, took nearly 3 years to climb back to its previous peak, but only because the broader market sentiment shifted dramatically. In contrast, the 2022 crypto winter saw a 60% drop, and as of today, the market has yet to reclaim those lost levels. The longer the recovery, the higher the opportunity cost. Your capital could have been earning modest returns elsewhere. A surprising fact: during periods of extreme crypto volatility, traditional assets often move in the opposite direction. In March 2020, when the COVID-19 panic sent the S&P 500 down 34% in a single month, Bitcoin initially rose, briefly defying the market trend. Yet the divergence lasted only a week before both markets fell together. The lesson? Correlation isn't static. Crypto's low or even negative correlation can be a double-edged sword. It may provide diversification during a stock market slump, but when panic spreads across all asset classes, crypto's supposed independence evaporates, and you're left with simultaneous losses. Let's talk about liquidity, another hidden layer of risk. Liquidity measures how easily you can buy or sell an asset without moving the price. The U.S. Treasury market, for example, can absorb billions of dollars in trades each second with barely a ripple. Crypto markets, especially for smaller altcoins, are far thinner. A single large sell order can trigger a cascade of stop losses, amplifying the price drop. This phenomenon, known as liquidity crunch, turned a modest $1 billion sell-off into a 30% plunge for many tokens in early 2021. Even Bitcoin, the most liquid crypto, can experience severe slippage during high-frequency events. Imagine trying to exit a position while the market is crashing. You might end up selling at half the price you expected. Retention bump. Did you know that during the 2021 GameStop frenzy, the Nasdaq's volatility index spiked to its highest level since 2008, yet Bitcoin's volatility index was still double that number? The disparity isn't just academic. It translates into real-world pain for investors who think they're hedged. Now consider the psychological dimension. Human beings are wired to react to loss more strongly than to gain, a principle known as loss aversion. When a traditional stock drops 20%, many investors shrug and hold. When a crypto asset drops 70%, the same investors often panic, selling at the bottom. This behavioral bias compounds the statistical risk. Studies from behavioral finance show that investors who experience a loss greater than 50% are 60% more likely to abandon the asset class altogether. In crypto, that threshold is crossed far more frequently than in equities, leading to higher churn and, paradoxically, more price volatility as new participants flood in during rebounds. Let's illustrate with a real-world scenario. Imagine a 30-year-old software engineer named Maya. She hears about crypto from a friend, invests $5,000, and watches the price double in a week. She adds another $5,000, chasing the hype. 6 months later, the market crashes 65% and Maya's portfolio is worth $3,500. She panics, sells everything, and ends up with a loss that could have been mitigated by a more diversified, lower volatility approach. If Maya had allocated the same $10,000 across a balanced mix of S&P 500 index funds, total bond ETFs, and a modest crypto exposure, her overall portfolio would likely have been down only 10–15% during the same period. The difference is stark, and it's not about missing upside, it's about preserving capital to stay in the game. Another retention bump. Over the past 5 years, the average crypto investor's net return sits at roughly 12% annually, while a diversified stock bond portfolio yields around 7% with far less drawdown. The higher headline numbers for crypto are often inflated by a small group of early adopters, not the average participant. Now we move to the real risk that most crypto enthusiasts ignore: regulatory shock. Traditional assets operate under a well-established legal framework. When the SEC announces a new rule, the market reacts, but the shock is usually bounded. Crypto, however, lives in a gray area. A single regulatory announcement from a major economy, say China banning crypto mining, or the US Treasury classifying certain tokens as securities, can trigger a market-wide panic, wiping out billions in minutes. The frequency of such regulatory jolts is higher for crypto, adding a layer of volatility that cannot be captured by standard deviation alone. It's a volatility of policy, not just price. Consider the 2023 US Treasury crackdown on stablecoins. Within a week, the market cap of the top 5 stablecoins fell by $30 billion, and Bitcoin's price dipped 12% as investors feared a broader liquidity squeeze. This event illustrates that crypto's volatility is not just market-driven. It is also policy-driven, and the latter is notoriously unpredictable. Let's address the crypto-only argument that the market's volatility is a sign of its youth and will settle as it matures. History offers a cautionary tale. The dot-com bubble of the late 1990s saw internet stocks with volatility comparable to today's crypto. After the bubble burst, many companies vanished, and the surviving firms never returned to the same growth rates. While the Nasdaq index eventually stabilized, the overall sector's risk profile remained higher than the broader market for years. The lesson is that volatility can diminish, but it rarely disappears entirely, especially when the underlying asset class remains speculative and underregulated. Now, a surprising twist. Despite all this volatility, a growing body of research suggests that the shape of crypto drawdowns may actually protect long-term investors in a counterintuitive way. When a crypto market crashes, the majority of retail participants exit, leaving a core of highly risk-tolerant holders. This survivor bias creates a smaller, more resilient community that is less likely to sell on subsequent dips. Over a decade, the remaining holders tend to have a higher average cost basis, which means that when the market recovers, the percentage gains appear larger. In other words, the extreme volatility weeds out the weak-handed, leaving a tougher pool of investors who can ride the next wave. It's a brutal form of natural selection, but it does happen. Retention bump. In a 2022 analysis of Bitcoin wallets, only 15% of addresses held more than 50% of all Bitcoin. Those top wallets have survived every major crash, and they now control a larger share of the supply than ever before. Concentration of holdings can amplify price swings, but it also means that the most committed investors are double-downing, not fleeing. Finally, let's bring the statistical reality back to everyday decision-making. If you're evaluating an investment, ask yourself 3 questions. What is the maximum historical drawdown? How long did it take to recover? And what external factors could trigger a similar event again? For traditional assets, the answers are usually moderate 30–50% drawdown, recovery in 2–4 years, and triggers like recessions or interest rate changes. For crypto, the answers often read 70–80% drawdown, recovery in 3–5 years or more, and triggers that include regulatory bonds, exchange hacks, or sudden shifts in mining profitability. Those numbers should shape how much of your net worth you allocate to each class. If you're comfortable with a 70% loss and have a long horizon, crypto's upside may be appealing. If you need stability, or if your financial goals are time-sensitive, the volatility may be a deal-breaker. The key is not to let the hype dictate your allocation, but to let the hard data guide it. In the end, the story that crypto bros don't tell you is simple. Volatility isn't just a buzzword. It's a measurable, relentless force that reshapes portfolios in ways that glittering promises cannot hide. The numbers show that crypto's drawdowns are deeper, longer, and more frequent than those of any traditional asset class. Yet paradoxically, those same forces can create a hardened community of investors who thrive on the very chaos that scares others. Understanding that duality is the only way to make an informed choice. So here's a question for you. After hearing the raw statistics and the hidden dynamics, would you adjust the size of your crypto exposure, or does the potential for outsized returns still outweigh the volatility risk in your mind?